Hello and welcome back, guys. So in this particular session, what we'll be doing is that we'll be doing this particular question called Fubuki. Right, so let's see. It's an unlisted company, based in Megera, which has been manufacturing electrical parts, right, used in mobility vehicles for people with disabilities and elderly for many years. These parts are exported to various manufacturers worldwide, but at present there is no local manufacturing mobility vehicles exported. Manufacturing. Okay, so it wants to. There is no manufacturers worldwide, right? So retailers in Magera normally import these vehicles and sell them at an average price of this much, right? Fubuki wants to manufacture mobility vehicles locally and believe it can sell equivalent quality product at a discount of 37 point thing, right, to the current average retail price. Okay, right now people are importing it, right? Electrical parts only, right? So now it wants to what? These parts are exported to various. At present there is no local manufacturing of mobility vehicles, right? So electrical parts only. Right now it's just doing that wiring electrical thing only, but now it wants to make a vehicle itself, right? And then it's planning to sell it at an equivalent of this much, right? 37.5. And then although this is a completely new venture for Fubuki company, it will be in addition to the company's core business. Okay, it will be in addition to the core business. Fubuki director expect to develop the project for a period of 4 years. Okay, we have our years, and then sell it for this much to a private equity. Magera government has been positive about the venture and has offered Fubuki a subsidized loan. APV, right, up to 80% of the investment fund required. So up to 80% at a rate of 200 basis points, right, 2% below Fubuki's borrowing rate. So currently borrow at 3 basis point, right, above the 5-year government yield rate. Okay, so we have to calculate that as well, I guess. 5-year above government yield rate. The feasibility study commissioned by the directors at a cost of 250,000. This is a sunk cost, not to be included. And then the following information, right? So initial cost of acquiring premises will be this much, plant and machinery is this much, okay, plant and machinery will be that much, premises is 11 million, right? Acquiring the premises and installing the machinery is a quick process and manufacture can commence almost immediately. So this is an assumption, assumption. Always write that, because normally this kind of venture takes a lot of time, right? So this is assumption, I'm pretty sure. It can be written in assumption because I've seen many questions, they normally do it. It is expected that in the first, so if you happen to start doing many questions, you'll see this kind of information. They normally put it in assumptions, okay? So it is expected that in the first year, 1,300 will be manufactured and sold, and then the sales will grow by this much. Unit sales will grow by 40%. So first year 1,300 in each of the next 2 years before falling to annual growth rate of this much. So we have a perpetuated thing as well, right? After the first year, the selling price per unit is expected to increase by that much. Expected to increase by this much, right? Selling price. So that means the discount amount plus 3%. After the first year, always remember this word. In the first year, it's going to be that, I guess. In the first year, it's just going to be 4,000 minus 37.5. In the first year, it is estimated that the total direct manufacturing labor and variable cost will be this much. After the first year, the direct costs are expected to increase by an inflation rate of 8%. Okay, that's easy. Overhead annual fixed overhead would be 2.5 million, of which 60% are centrally allocated overhead cost. So 60%, right? So that won't be basically included. 60% are centrally located, right? So Fubuki will need to make working capital and all these things are there at the beginning of the year. So working capital, all right, we'll need to make working capital available of 15% of the anticipated revenue for the year at the beginning of each year. Okay, that's easy. The working capital is expected to be released at the end of the 4 year, so we just need it for 3 years and then just add it up, right? Tax rate is 25%, and then tax is payable in the same year as when the profit is earned. Tax allowable depreciation is available on the plant and machinery on a straight line basis. It is anticipated that the value attributable to the machinery after 4 years is 400,000 value attributable at which the project is sold. Okay, value attributable to the thing is that much, right? Tax payable is in the same year when the profits are earned. TAT is available on a straight line basis. Okay, for 4 years. No tax allowable depreciation is available on the premise. Okay. Project is sold at this much, right? 400,000. Okay. So out of the project selling thing, right? It is planning to sell it as well, right? For 16 million. Out of that, 400,000 is for the machinery. How much did we buy it for? Machinery, where are you? Machinery, 3 million. Okay. Fubuki uses 8% discount rate for new projects, but feel these rates may not be appropriate for this type of investment. It intends to raise the full amount of funds through debt finance and take advantage of the government offer of a subsidized loan. Issue costs are 4% of the gross finance required. It can be assumed that the debt capacity available to the company is equivalent to the amount of the debt finance raised to the project. Okay. 4% is their issue cost, right? So we will have to use, so we are discounting it at different rate. So we will have to use some kind of thing as well. APV calculation should be there, right? We will need to compute all those things. I'm pretty sure there will be some kind of, you see, beta calculation as well, right? Although no other companies produce mobility vehicles in Maghera, blah, blah, blah. A listed company produces in Maghera. Haizamco, a listed company, listed. Okay, using similar technology to required electrical powered vehicles. The Haizamco cost of equity is estimated to be this much. Cost of equity, KE, 14%, right? And it pays tax at 28%. 28%, okay. Has this many shares trading at this much and 40 million bonds trading at this much. The 5-year government yield is currently at this much, right? Okay. So how much were we allowed to borrow at? 4.5% plus something was here, 4.5 has been positive of the venture and has offered a subsidized loan of up to 80%, right? At a rate of 200 below borrowing rate. Can borrow at 300 basis points, so 3.07.5. So it can borrow at 5.5, right? Okay. Let's calculate the base NPV first of all, right? So in order to do that, what is the question number? 38, right? 38. Let me just open it up. 38, right? 38. Should be here. Just give me a second. 37. 38, right? Fubuki. Okay, so let's see. So what does it say over here? Okay, so APV is a commonly tested, right? Commonly tested, and as long as you remember to use the ungeared cost of equity for discounting, the project operable is identical to standard NPV question. In calculating the present value of the taxi land subsidiary in this model answer, the annuity factor is used based on the 4.5% yield for 4 years, and it could be argued that 7.5% may be used as this reflects the normal borrowing or default tricks of the company. A full credit will be given where the assumption was made. Okay, so even though if you make an assumption as such, there won't be any problem, right? Okay, base case NPV, right? So Fubuki project evaluation, right? So that's what we are evaluate on financial grounds, right? Whether we should proceed or not. So always step one is base case, right? Step one. So how many units produced? So let's just calculate all those things. Sales revenue was what? Where is it? Sales revenue. Working one, not that. Sales revenue was okay. 4,000 into unit is how much? Unit. There was something about that. 1,300, right? So 1,300. This much units are there, and then sales revenue is that much, 2.5. So that just means 4 minus 37.5 should be that much. 64 into how much is that? 37.5, 12.5, 62.5%, right? 2.5, yeah. So 2,500, right? 2,500, yeah. 2,500, and then after that it's going to inflate at that rate. So 2.5 into 1,300. It's not going to inflate in the first year, so it's just going to be that. All those values, and then we have some direct cost as well. What is that direct cost? Unit sales will grow by 40%, right? So it's just going to be 40%. So 1,300 into 1.4, 1,820, and then again 1.4 into 1.4, and then after that it's going to be for the final year, because we are only going to have it until year 4, right? For the final year, yeah. For the, no, I was saying perpetuity. I did not read that final year because it's only going to last for 4 years, right? So it's not going to have a perpetuity. And then it's just faltering over here to 5% growth rate, right? Yeah, 2,548 into 1.05, so 2,675. Okay, good. Sales revenue is just inflating at that rate, right? So we can calculate that. That's not a big thing. And then direct cost. What's happening with the direct cost, right? Direct cost 1,200 per unit. So 1.2 into 8%, right? So 1,560 divide by 1.2. It's 1,300, isn't it? So 1,560 into 1.08. 16, okay, 1,820. 1,820 into 1.2 into 1.08. 2,359, yeah. Direct cost is that, right? And then another I wanted thing, appropriate cost, right? Attributable fixed cost. That's what I wanted to find out. Fixed overhead cost will increase by that, right? So 60% is currently centrally allocated, so 40%, okay. I thought it was apportioned, so I was thinking about that, but it's 60% is centrally allocated, so we can basically estimate for the project, so that's good. Otherwise we normally don't do it, right? So if we can't estimate it properly for the project, how much are we going to use that, right? 2.5 into 0 0.4. 2.5 into 0 0.41, right? So it's 1000. Okay, good. And then it's just going to inflate by that 1.05. We can calculate that. And then what do we need? Next cost is basically around working capital, right? So it's just 15%. So it's 15% of this 15%, this 15%, this 15%, right? Wait a minute. 4687 into 15%. 703 minus 488. Yeah, it's not only like that easy, it's that simple, I mean. Okay, all these things are done, and then we have some taxes. And right, I just wanted to confirm about depreciation. How much are we allowing over here? So we are purchasing the machinery at what price? 3 million, right? So 3 million divided by 4. How much are we selling it for? 0 0.4. So 3 minus 0 0.4, 2.6 divided by 4. 0 0.65 into 1000. 650, yeah? So how did we get this depreciation? I'm pretty sure everyone knows it, but still just writing it out there. 3 million minus 0 0.4 divided by 4. That will be what? 2.6 by 4. 213. Right, and then that is 0.65. That's how we got it, okay? And then based on that, we just subtracted, and then we just put in the taxable profit, and then we put in the rate. So what was our rate? Tax rate is 25%, right? So 410 is the 25% of 40, right? So we know that. That's done. Then no tax allowable depreciation is thing, right? Okay. Okay. So we basically just did the working for taxation, right? Directly. And then after that, you could do it in another way, but that's up to you, right? So you could basically be deducting the profit and then doing it as well, right? So you could be doing that as well. And then where is that? Investment, right? Investment, how much are we investing? 11 plus 3. Always remember that, 11 plus 3. So 14,000, and then we will be recovering 16 million. 16 million, but okay, I wanted to check in this thing as well. I did not mention about this working capital being returned. It's all this amount, right? And then another thing that I wanted to confirm was what I wanted to confirm was how much are we getting back. So 16,000, right? That's there. And then what else? Net cash flow is that, right? And then we discount it at discount rate, right? We need a discount rate for that. And then for using a discount rate, what we can do is, so we have another company whose cost of equity is there, right? KE is there. So based on that, since we don't have the beta of it, right, what we can do is we can use the discount rate, right? We can use we can use that formula. Remember, we had that Modlani and Modlani, something like that, right? So Modlani formula is basically Tutorial note: in calculating the on-geared cost of equity, the model has used Mulvaney formula from the formula set. The same answer could be derived using the asset beta formula and CAPM model as well, right? So what we can do is basically, okay, so RI, that's our required return, right? RF plus beta I, or beta, let's just say on geared beta, and then ERM, return from market, minus RF, right? So this is 14% equals to 4.5% is our rate, plus beta times the market premium is 4%, right? So from there we can compute the beta value. Okay, so beta value is basically 10.5% divided by 4% equals to, right, 10.5 into or divide by 0.04 to 62.5. I mean 2 point something, right? So that is what, that is equity beta, 2.375, right? So we have to ungear it. After that we get the ungeared beta, right? And then now we have to gear it using our scenario, right? Or what we can do is, that's the asset beta, right? And then we can just use that again in our situation. So we get 10.02, right? Now what we can do is we can basically, we don't need whack, right? Remember one thing over here, why are we using the beta assets only? Because we are trying to find out ungeared cost of equity. Okay, ungeared cost of equity, that's what we are trying to find out. Because on base case NPV, why do we use APV? In the first step, what we do, we assume that it's not yet, it's completely financed by equity. Okay, so that we leave the financing side effect in step number 2. Okay, so the base case NPV is there, right? So next thing, we will calculate the financing side effect of it, right? So we discount using that rate, and then we get 708, right? That's the base case NPV. Now we move on to the financing side effect. So what do we have? In financing side effect, what things go in? We basically have some issue cost, we have some subsidized loan and all as well, right? So that will have some tax relief, and yeah, and then the subsidy benefit also is there, right? So issue cost is what? Issue cost is 4%, right? 4% of the gross finance raised. How much are we trying to raise? We are trying to raise 80% of the investment will be at the rate of this much. So there is a segregation of it, right? Investment funds required is 14, right? 14 plus, always don't forget this, it's this amount. Okay, just pick up from this amount. I always forget, but yeah. Working capital, including the working capital, 14,488. Okay, always that amount. And then right, and then what we do, we multiply by whatever the rate is, right? So 4%, right? So 4 by 96. Okay, okay, and then after that we get this much, right? Issue cost. And we also attract some tax relief on it, right? So 14,000 into 80% into how much is the rate? So what was the rate? It's 5.5, right? into how much percent was the tax benefit. So 25%, right? Tax shield, we are computing tax shield. And then 14,000, 20% times 7.5% times 25, right? So that will give us a saving of this much tax relief, right? And then tax relief, and then we are saving that much annually, right? Annually. So we have to use an annuity factor for 4 years. So annuity factor for 4 years, right? So we could be using this rate, 4.5%, right? 4.5% to as an annuity factor, right? And then what else? Subsidy benefit is also there, right? So we are receiving some of that, right? So that should be there as well. So subsidy benefit, we always compute it net of tax. So 14 thing into 80%, right? 80% of it is only we are getting subsidy, so that's only where we are getting subsidy benefit. And then we are getting benefit of 2%, and then we are paying a tax rate of this much, and then annuity factor, and then we get the subsidy benefit, right? And total benefits from financing side effect is basically this much, right? And our adjusted present value will be after we've taken in the account of base this plus the base NPV, we get the value, right? So another thing that I wanted to basically tell over here is that the addition of the financing side effect gives an increased present value, right? Because we are adding all this tax relief, there is subsidy as well, right? So, and probably the project would not be considered marginal, right? Without that, how much was it? It was 708, right? So this is in thousands, isn't it? So earlier it was very like it was considered not so attractive, right? So after taking in account of this financing side effect, the project might be even more attractive to the investor, right? So always remember, if you've got an NPV kind of question, always you will be asked, it's the same pattern. This is a perfect example where you will have this basic computation that we need to do, right? And then you will need to find your beta. So there will be some kind of beta calculation of a similar company will be given. So if it is there, normally they will give you beta equity. Okay, so that's a geared, right? So what you have to do is you have to find the value of equity, value of debt, right? And then you might sometimes have to be like finding let's say the value of debt and all everything, right? And then only you can find the cost of equity. Okay, so in order to do that, normally what we do is basically normally we have like beta equity, and then from there you ungear it, then you get beta assets, and then what do? You use this thing in our we put that value in CAPM, and then we get our discounting rate. We discount it at KE only, not WACC, KE. Okay, we discount it as if it's been financed solely by equity. Okay, so yeah, so in this case they have used Modlani and Modglini, right? So Modglini and Miller, I always forget the name, man. M&M, that's what I normally use, but you will be given the formula in the thing as well. And then what you can do is basically you can compute it, but what you need first of all is value of equity and value of debt, right? So that's already been given, 2.53 trading at 15 million shares, right? 15 million shares. So 15 into 2.53 will give us this much. Value of debt is 40 million trading at 9.88 per 100, right? So what do we do? 9.44, 88 divide by 100, right? And that will give us 37.953. And then there is assumption made over here, huh? Value of debt divided by equity is 1, right? So where's this saying? It's 1 to 1, because you see the value of debt and this thing is, there is not much difference, right? It's only marginal. That's why they are assuming it to be 1. So based on that, we just plug in the formula and then we get the cost of equity if it is ungeared, because this is geared. 14% is geared, or we could just use a CAPM model as well, right? Yeah, that is one thing. Based on that, you can get your basic case NPV, and then after that, always take into account if there is any issue cost or not. And when computing your issue cost, always assume this amount, whichever amount is that, to be 14,488 into issue cost is 4% of it, right? Always compute that as if this is like, just assume this to be 96, okay, and then compute it. And then for tax shield as well, always take care of like if the project is fully financed with the subsidized loan or how much of it is financed, right? So they will always tell that, like there will always be a similar pattern in the question where like it's not every finance is not like finance with the subsidized loan. They will only have like subsidized loan for certain amount of loan and there will be some remaining loan, right? So in this case we've just done that, right? We've segregated the subsidized loan, tax shield, and then the other subsidized tax relief as well for the 20% that was remaining out of 14,488, right? So similarly for tax benefit as well, what do? We don't receive any tax benefit for that loan that you're paying at a normal rate, right? So if you're paying the loan at a 7.5, you're not receiving any subsidy benefit. That's not there is no subsidy in that. So always be careful about this, right? So discuss the appropriateness of the evaluation method used and explain any assumptions made in the part A. So I think this will be 4 marks. This will be 4 marks, I think so. Appropriateness of the evaluation method, right? So adjusted present value can always be used when the impact of using debt finance is significant. Impact, you remember when the gearing changes, when like you have subsidized loan and all, right? So that's always there. So here the impact of financing side effect from the debt is shown separately rather than imputed into average cost of capital. The project is initially evaluated by only taking account of the business risk element of the new venture. This shows that although the project in a net present value results in a net present value, it is fairly marginal, right? And volatility in the input factor could turn the project. So sensitivity analysis should be considered to examine the sensitivity of the factors. The financing side effects show almost 110% value, which is added when the positive impact of tax shield and subsidy benefits are taken into account, right? So this gives us a bit of a detail, a better picture, let's just say that way, right? You see the value itself is 786, right? 786, right? Right, so if you divide this amount 786 by 708, you will get 110%, okay? Is added when the impact of the tax shield is taken into account, remember? You see? And then we have to discount it at different rates as well, right? So that's why also this is very important. And another thing, we need to provide some thing as well, assumptions as well, right? There is some marks over here. This is discussion of APV and APV method, assumptions in this thing, and then in Mortlani there is some marks as well, 3 to 4, 2 or 3 for other assumptions, right? So 4 marks over here for sales revenue and all. Incremental working capital is 1 marks. Taxation is 2 marks. Estimation of KE is 2 marks. NPV, base case NPV is 2 marks. Issue cost is 1 marks. Tax shield and all is 2 marks. Right, because we had to do some segregated, right? APV and conclusion is also there. So let's just see the assumptions. So high-jump ungeared cost of equity is used because it is assumed that this represents the business attributable to the new line of business. That is the assumption that we made, right? The ungeared cost of equity is calculated on the assumption that Morgan M&M proposition 2 applies. Okay, we just assume that. Assume that the initial working capital will form part of the borrowing funds, but the subsequent requirement will be available from the funds generated from the project, remember? So this is also a generic statement that you can write in a lot of these kind of question, okay? A lot of this question. The feasibility is ignored as a past cost. Remember the 230,000? I think that's what it was, 250,000, okay. It is assumed that the 5-year yield is equivalent to the risk-free rate. Yield, right? So yield is currently estimated 5-year. Huh? Okay, I missed that 5-year thing, right? So it's assumed that the annual reinvestment needed on the machinery is equivalent to the tax allowable depreciation. Right, because of this assumption, you are not adding back the TAD. Otherwise, you would have to add it back because you won't be making that investment. Otherwise, if you're making that investment, that's why what's happening is basically we are subtracting it from here and then we are adding it back as well, right? Right, if you were not making that investment, you would have to add it back. Otherwise, because this assumption has been made that you will be making that kind of that amount of investment, so we are not adding it because the cash is going out, okay? That's why. It is assumed that all cash flow occur at the end of the year unless specified otherwise, and then the taxes are payable at the end, right? So that's not assumed, but it's paid. You could say that as well. So all amounts are given in thousands to the nearest three zeros, right? When calculating the unit produced, sold, and nearest approximation for each year is taken. Assumption 4, 5, 6 are standard assumptions made for questions of this nature. 4, 5, 6, 4, 5, 6, 7, 8. Okay, are warrant for the discussion. So taking assumption 3 first, right? Working capital, right? So it is reasonable to assume that before the project starts, the company would need to borrow initial working capital as it may not have access to the working capital needed. In subsequent years, the cash flow generated from the operations may be sufficient to fund the extra working capital required. In case of Fubuki, because of the expected rapid growth in sales in year 2 and year 3, the working capital requirement remains high, and then the management need to assess how to make the funds sufficient, right? Okay, appropriateness, okay, of the evaluation method. Of course, this has to be there, right? Otherwise, there will be liquidity issues. Considering assumption 1 and 2, the adjusted present value methodology assumes that M&M proposition 2 applies an equivalent ungeared cost of equity, does not take into account the cost of financial distress. Right, equivalent ungeared cost of equity, which we found out using M&M, right? It does not take into account the cost of financial distress. This may be an unreasonable assumption. The ungeared cost of equity is based on another company which is in a similar line of business to a project, but it's not exactly the same. It can be difficult to determine an accurate ungeared cost of equity in practice. Ungeared cost of equity in practice, because you won't know which company to basically compare it with, right? The main thing is that. However, generally the discount rate tends to be a least sensitive factor in investment appraisal, and therefore same latitude can be allowed. However, generally cost of funds, discount rate it tends to be least sensitive factor. It's not sensitive in investment appraisal, and therefore some latitude can be allowed. Okay, so good question, right? Good question. Fun. All right, that's pretty much it for today. I will see you in the next question. Take care. Bye-bye.